Let's also get some reaction from the world of business. David Rosenberg, one of our regular guests here on BNN Bloomberg. He's the chief economist and strategist at Rosenberg Research and Associates, joining us now. David, good morning to you, and I'm wondering how you're viewing this whole situation.
Well, look, notwithstanding, John, how disturbing and disgraceful and embarrassing it was yesterday, if you're boiling it down to, what matters for the markets, the reality is that nothing that happened yesterday has any influence at all on the future direction of the economy, corporate earnings, or interest rates. So it's really that simple. The market is really focused on the Fed, which remains hugely accommodative, and looking at the bright side of, I guess you would call it a blue ripple and not a blue wave, but irrespective of that, the prospect that we're going to get even larger fiscal stimulus is really what has the market salivating more than anything else. Remember, this is a market that needs and is thriving on monetary and fiscal policy stimulus, and it sees now that in the near term it's going to be getting a lot more of that.
Those are all very fair points as we take a look at the U.S. futures. It was before that violent activity, David, you're absolutely right, that because of the way things played out in Georgia, there was a determination by the market that more Democratic power in Washington could fuel the idea of more stimulus coming. But I also wonder if the idea of calm being on the horizon is something the markets are watching as well. Obviously, it was President-elect Biden who was first to speaking on camera before we even got that Twitter video from President Trump. How do you think the markets, the business world looks at the Biden era coming so quickly as something that maybe can't come soon enough?
Well, I mean, the reality is that it's been 2 months now since we had the U.S. election, so there's been plenty of time for the markets to become acclimatized to a Biden administration. There's nothing there that's really new. Shortly after the election, really less than a week, we got, remember, Pfizer Monday, and we got the vaccine news. We got on top of that, ongoing comments from the Fed that they're going to remain accommodative and keep interest rates at the floor and their balance sheet bloated as far as the eye can see. So, again, this is a market that is being fueled by liquidity and by unrelenting policy stimulus. This is really, in some sense, not even about the fundamentals, and it's certainly not necessarily about the politics. I think that what the market priced in the past couple of days, when you're looking at, what is the implication, for example, the government is not part of the S&P 500. But it is a part of GDP, and so we're going to get a lot more spending. That spending will find a way to trickle its way somehow into corporate profits. You've already seen some economists raising their GDP numbers for this year to over 6%. We haven't seen that since the Reagan era. So when you combine this rampant fiscal stimulus, a lot of it is hope right now, but it looks like we're going to get even more on top of what the Fed is doing, and then you superimpose that on the biggest surprise. The biggest surprise, John, is not that the market has rallied through the violence on Capitol Hill yesterday. The biggest surprise was how we managed to have a phenomenal year in risk assets during a pandemic. And so, again, it just comes down to the Energizer Bunny here. This is a gift that keeps on giving. The bear market in the past year has been in rational thought. If you're just focused on the money supply numbers, the Fed balance sheet, and what all that means for risk appetite and the PE multiple, you'd have been a big winner in the markets last year, notwithstanding the fact that we still have 20 million Americans on some sort of jobless benefit.
Yeah. No, those are all fair points, too. Before I let you go, David, while I assume if you're say, a CEO in corporate America, given everything you're talking about, you could make an assumption that, well, this is not my business, and to your point, I'm being asked to deliver profits to shareholders, and yet we're sitting here this morning seeing many CEOs, many corporate leaders in the United States who have been weighing in on this matter. On some levels, we are talking about a different era for corporations around the world to be more active, for the leaders to be more active. And I think the other big issue, and even our colleagues at Bloomberg have been writing about this in some of their opinion pieces, the credibility of the United States literally being stormed, given all this chaos that we have seen. How do you feel about that part of the story, David?
Well, look, firstly, corporate CEOs, and especially the responsibility for their businesses and also for their shareholders, what do they crave the most? They crave stability, financial stability, economic stability, and political stability. So, I think that not a case of too little too late. I mean, yesterday was quite shocking, but, we have to remember that, America is a country that was born out of violence. It was just over 150 years ago that they had a civil war. I do believe that there's a case to be made that a lot of this is temporary. I think that's something we said, that a Biden administration will be a calmer influence. I think that's almost a no-brainer comment. But let's boil it back down to the markets. We had the most chaotic administration in history, certainly modern history, that didn't stop the stock market from embarking on a one-way ticket north. So we have to separate, what makes sense in Main Street and really what ultimately drives Wall Street. When you're taking a look at when the one time that the stock market really tumbled was in the fourth quarter of 2018. Did Donald Trump do anything different in the fourth quarter of 2018 that would have caused the stock market to plunge? No, it's because the Fed was tightening monetary policy, raising rates and inverting the yield curve. And then the next thing you know, Jay Powell was doing a huge about-face, what they call the Powell pivot. So it just goes to show you for the markets, it's really the power of the Fed. There's nothing that Trump can do, and there's really nothing that Biden can do on the other side of the spectrum that's going to combat, 25% annual growth in M2, 67% growth in M1. The highest growth rates we got on the money supply in the 1970s was like 15%. So insofar as the economy doesn't absorb this liquidity, it goes into financial assets, and that's why you have this massive disconnect. But in answer to the question, I would say that, the Biden administration will obviously have a calmer influence domestically and worldwide. But that's not what's driving asset markets right now. It's really monetary policy on steroids, and coupled now with these hopes that we're going to get even more acute fiscal juice into the system. And that's really what's driving risk appetite right now across everything, from Bitcoin to corporate credit to equities, and now the most cyclical parts of the equity market. So it's got nothing to do with the politics per se. It has to do spinning the dial on fiscal policy at the margin. We're going to get more of it, and this ongoing massive support by the Federal Reserve.
David, we appreciate your thoughts as always. Thanks for joining us this morning on this breaking news.
All the best.
It's David Rosenberg of Rosenberg Research and Associates.